I've heard a lot of investors talk about the US Treasury as if it's a credit. Do you think they're sort of overstating the problems that we've got in Washington, D.C., or do you think that's fair enough?
I don't think the U.S. Treasuries are a credit. Again, if you compare with other sovereign bond markets, you're kind of looking at probably, again, the cleanest dirty shirt. So, the government has the ability to pay its debt and will continue to do so. So it's not a worry to me. Maybe that could change, but it's not a worry.
When you say others, relative to who? Let's talk internationally. What are you talking about?
So right now, by the way, internationally, we're long European stocks. But in the bond markets, we've also added to non-U.S. bonds. We're overall short treasuries. And we like non-U.S. bonds because in a lot of markets, there's a desire to lower rates probably faster than in the U.S. And, we hedge the exposure. So we like that tactically. We still hold treasuries. We're just underweight. We're also long equities in Europe.
Well, just to build on that, there's this question about whether you love this on a relative basis or whether it's a currency trade, right? Whether ultimately this is going to come down to the rate differentials or whether this is something having to do more with the idea of credit and desire to be in a particular country.
Look, again, I don't think that U.S. Treasuries are a credit. I do think that there are real concerns with deficits and budget, and that is starting to be reflected by bond investors. I know you all talk often about the bond vigilantes, but I don't think it's the same thing that, for example, happened in the UK with the Liz Truss moment. I know you've talked about this on your show.
Extensively.
So it's more about diversification. Like, we don't want to have just treasuries, and we think there's an opportunity for rates to come down for some duration gains outside the U.S., so we go long.
So you talk about the equity portion, particularly in Europe, and a lot of people are saying maybe that's been overplayed, given the fact that they still have to get their act together. Yeah, yes. It's significant. It's up a lot. Yeah. And there is this feeling of whether European nations are going to come together and actually make an agreement. Do you think there's more upside?
I think there's more upside, but you're right. Europe has outperformed the U.S. on the equity side by 10% year to date. So, it's starting to feel rich. But, give Europe a break. It's actually underperformed the U.S. by 138% over the last 10 years. It's been a value trap. Now, a lot of strategists will say there's a valuation advantage. And there is one, even if you control for the different sector composition between Europe and the U.S. And there's a reason why the U.S. has outperformed. It's actually justified by fundamentals. If you look at the return on equity of the U.S. stock market, it's consistently improved and trended up. And in Europe, it's been flat. However, that differential is now flattening and trading sideways. So fundamentals are starting in terms of growth and sustainable growth to look more similar in terms of the rate of change. Then you add on top of that, what's the catalyst to unlock the valuation advantage? Well, German stimulus, easy monetary policy, and a banking sector that now can make money because we've escaped the zero-rate environment. So banking sector in Europe that's trading at 1 times book value, used to be 2 times book value pre-financial crisis, still an opportunity here. All that, I'm saying, with the caveat that we still like U.S. stocks for the long run. I'm not talking about the end of U.S. exceptionalism. I'm talking about a tactical overweight where the valuation advantage of Europe can continue to get unlocked over the next 6 to 12 months.
Key word is tactical. Time frame is 6 to 12 months.
Yes.
That's not a man that's betting this decade-long structural underperformance is over. Is that fair to say?
I'm not. I think the U.S. big tech companies are awesome. The way they generate cash flows, the way they protect their margins, the way they grow, the innovation. And I think that in the long run it will continue, but they're trading, this is all priced in, they're trading at high multiples.
How does the tariff story factor into what you're describing, the lack of a deal between the Europeans and the US?
Yeah, the counterintuitive thing about the tariffs here is that they've actually prompted Europe to do more for themselves, including stimulus. And perhaps there's a deregulation impulse that will come out of Europe as well. So you do this, you set all these barriers, and now you hear policymakers in Europe wanting to maybe be more like the U.S.